Welcome back to the Economic Compass, your weekly guide to understand the forces shaping our financial world. I'm your host Chandrakant, and today we are diving into the critical development from India that has implications for everyone, from investors to everyday consumers. The headline is the India's core sector hit a 3 months low. It's a phrase that might sound a bit technical, but trust me, by the end of this video, you will understand exactly what it means, why it matters, and crucially, what its potential impact could be on your wallet and your future. So let's start with the basics. What exactly is India's core sector? What are these? Think of it as a foundational pillar of any economy. In India's case, the core sector comprises of eight crucial industries, which are namely coal, crude oil, natural gas, refinery products, fertilizers, steel, cement, and electricity. These aren't just any industries, they are the bedrock upon which much of the rest of the economy is built on. If these sectors are thriving, it generally signals a robust and growing economy. Conversely, if they are struggling, it can be an early warning sign of a broader economic slowdown. The latest data released recently indicates that the growth in these core sectors have decelerated to a 3 months low. Specifically, the growth rate dipped to exactly quite low in terms of percentage terms, and this isn't just a minor blip, it's a trend that warrants close attention. Now, should this concern you, particularly if you are not an economist or a direct investor in these industries? Well, imagine these eight core sectors as the engine of the larger train. If these engines start to splutter, the entire train representing the broader economy will inevitably slow down. This slowdown can manifest in several ways that directly affects your life. Let's break down each of these core sectors and understand their individual significance. First, coal and electricity. These two are quite closely linked. They are like Siamese brothers. Coal is a primary fuel source for electricity generation in India. Its slowdown in coal production or consumption can directly impact power availability and cost. If the electricity generation falters, the industry that relies heavily on power, which is virtually every industry today, from manufacturing to IT, will face huge cost on production and a lot of other constraints. For you, this could mean higher electricity bills or even disruption in services that depend on stable power supply. On a larger scale, it can deter new investments and industrial expansion. Next is a crude oil, also the natural gas, and the refinery products. These are vital for energy security and transportation. A decline in their growth often points to reduced industrial activity, less demand for fuel in transportation, and potentially a weaker outlook for consumer spending on goods that require transportation. If fewer goods are being moved, it suggests less production and less consumption. For the average person, this could eventually translate to higher fuel prices if supply is constrained, or sign shows that the fewer goods are moving through supply chain, impacting availability and potential price rise. Then we have the fertilizers. This might seem like a niche, but it is absolutely critical for India's agriculture sector, which employs a vast portion of the population and contributes significantly to the GDP. A slowdown in fertilizers production or demand can signal challenges in the agriculture sector, potentially leading to lower crop yield, higher food prices, and reduced rural income. If the farmers are struggling, it has a ripple effect across the entire economy, as a rural demand is a major driver of consumption in India. So the price of your vegetables and groceries could be indirectly influenced by this particular sector. Now let's move on to steel and cement, which are the backbone of the infrastructure and construction. A dip in their growth is a strong indicator of a slowdown in construction activity, be it residential, commercial, or public infrastructure, and several other projects. When construction slows down, it impacts a massive ecosystem of allied industries, from labor and raw material supplies to real estate developers and home furnishing businesses. For individuals, this can mean fewer jobs opportunity in the construction sector, potentially slower growth in property values in some areas, and general sense of reduced economic dynamism. If the government is pushing for infrastructure development, a slowdown here could mean targets are being missed, impacting long-term economic plans. So we have established what the core sector is and why its slowdown matters generally. Now let's dwell deeper into what it means for you and me. And this isn't just an abstract economic data, it has a tangible effect on your daily life, your job, and your financial planning. Now let's look at impact on jobs as a first pillar. When the core industry slows down, it often leads to reduced hiring or even job losses. If the steel production is down, fewer workers are needed in the steel mills. If the construction projects are paused due to cement slowdown, construction workers and associated traders suffers. This effects can trickle down on a reduced income in one sector, lead to less spending in another, creating a domino effect across the economy. So if you are looking for a job or concerned about the job security, a core sector slowdown is a red flag. Next is a inflationary pressure or deflationary risk. This is a nuanced point. On one hand, if the production of essential raw materials like steel or electricity slows and demand remains strong, it could lead to higher prices for finished goods that use these inputs. Imagine a scarcity of steel driving up the car prices. On the other hand, a broader economic slowdown stemming from the core sector could also lead to reduced consumer demand, which might eventually forces businesses to lower prices to attract buyers, leading to deflationary pressure. The precise impact depends on the various other factors, but both scenarios have implications for your purchasing power. Next is the investment decisions. So, for investors, a slowdown in the core sector is a clear signal to reassess their portfolio. The industries depend on these core sectors like manufacturing, real estate, and automotive might face headwinds. Investors might consider shifting towards more defensive sectors or re-evaluating their exposure to Indian equities. Even if you're not directly investing in these industries, the overall market sentiment can be affected, impacting your mutual fund or retirement savings. Next is the government policy response. A slowdown in a core sector growth will invariably draw the attention of policymakers. The government might consider fiscal measures, such as increased public spending on infrastructure, to stimulate demand for steel and cement, or tax incentives for industries. The central bank, the Reserve Bank of India, might also respond with a monetary policy adjustment, such as interest rate cuts, to encourage borrowing and investment. These policy responses can directly affect loan interest rates for homes and businesses, as well as the availability of credit. So, if you are planning a major purchase or a business expansion, keep an eye on these potential policy shifts. Next is the consumer confidence. Perhaps one of the most insidious effects of economic slowdown is on the consumer confidence. When the people hear news of slowing growth, potential job losses, or rising prices, they tend to become more cautious with their spending. They might delay purchase of a new car, postpone home renovation, or cut back on discretionary expenses. This reduction in consumer spending in turn further dampens the economic activity, creating a vicious cycle. Our perception of the economy can directly influence your spending habits and therefore the broader economic outlook. Now it is important to put this latest data point into perspective. A 3 month low, while concerning, doesn't automatically mean the sky is falling. The economic data often fluctuates, and sometimes a slowdown can be temporary. It's just like a blip due to seasonal factors, specific policy change, or even global events. However, it is also crucial not to dismiss it. We need to look at whether this is a part of a larger sustained trend. Are there any other indicators that corroborate this slowdown? For instance, are manufacturing PMI numbers also declining? Is export growth flattening? Are private consumption figures slowing down and showing weaknesses? When multiple economic indicators point in the same direction, the alarm bell ring louder. Some of the potential reasons for this slowdown could be global headwinds. We all know that a lot of global turmoil going on. The global economy is facing its own challenges at this point in time, including inflation, interest rate hikes, and and all of this is happening in major economies like US, China, etc. And there are other geopolitical tensions. These can impact demand for Indian exports and also influence investor sentiment. There are domestic factors as well. High interest rates within India, implemented to combat the inflation, might be dampening investment and consumer spending. Supply chain disruption, even localized ones, can also affect production. Then we just finished the monsoon, and so let's talk about monsoon performance because this is a major phenomena in India. While not directly a core sector component, a weak monsoon can impact agriculture output, thereby reducing rural demand for various goods, which in turn affects industrial production. Then there are sector specific issues. There might be specific challenges within the individual core sectors. For example, issues related to land acquisition or environmental clearances could hinder new projects in steel or cement. So, what should you do with this information which has just come in? Panic is never good strategy. Instead, it's about being informed and prepare for it. The core sector performance is a vital barometer of India's economic health. While the current data points signals a slowdown, it's a call to vigilance, not despair. It's a prompt us to ask important question. Is there a temporary blip or the start of a more significant trend? What measures will policymaker take now? And how can we as individuals and businesses best navigate these evolving economic currents? Understanding these fundamental economic indicators empower you to make more informed decisions about your finances, your career, and your future. Keep listening, keep learning, stay engaged with the economic world around you. Thanks for joining live. If you have any questions or comment, leave them in the comment section below, and I will catch you again in the next one.